You watched silver crash from $90 and felt that knot in your stomach. You questioned your timing, your research, maybe even your entire strategy. But while fear was spreading across retail investors, something very different was happening behind the scenes. Massive buyers were stepping in quietly, not emotional traders, not short-term speculators, strategic, patient, powerful money. The kind of money that does not panic during crashes. The kind of money that uses panic as an entry signal. And when I followed the data trail they left behind, I found something that completely changed how I look at silver right now. Not a rumor, not a prediction pulled from thin air. A pattern, a repeating structure that has already played out multiple times in modern market history. A structure that does not just suggest higher prices, it points toward a violent repricing phase that most people are psychologically unprepared for. Because the real question is not whether silver can go higher. The real question is whether most investors will still be positioned when the explosive phase actually begins. History says most will not. History says most will sell too early, doubt too soon, or wait for a perfect entry that never comes. Let's start with something almost nobody is framing correctly. Silver breaking above $50 was not just another rally. It was the destruction of a 50-year psychological prison. Think about that carefully. From 1980 until recently, silver lived inside a cage. Every major rally slammed into that ceiling and failed. Generations of investors were conditioned to believe silver was permanently limited. Analysts repeated the same narrative for decades. Silver is volatile. Silver is unreliable. Silver always fails near $50. But during those same decades, other commodities escaped their cages. Gold moved far beyond its old highs. Copper broke out of its long compression and exploded. Energy markets repriced. Agricultural commodities repriced. Every major resource eventually broke free from historical ranges except silver. And when something stays compressed for half a century, the eventual breakout is not mild. It is violent. The pressure builds year after year until one moment finally releases everything at once. That is the context you need to understand the current market. This is not just another cycle. This is a structural reset after decades of suppression. And the moment silver broke above $50 and refused to collapse back into the old range, the market entered a completely new reality. The old rules stopped working. Now here is where things get really interesting. When you study previous explosive silver moves, you see a consistent rhythm. In 1979, silver went from around $12 to nearly $50 in a matter of months. In 2010, it surged from roughly $18 to almost $50 in less than a year. But the explosive phase, the part where prices moved almost vertically, lasted only a few months, not years, months. And right in the middle of both moves came a terrifying correction that convinced investors the rally was over. Sound familiar? A fast, brutal drop that forced weak hands out. A wave of fear, headlines declaring the end. Technical analysts screaming overbought signals. And right after that, shakeout came the final acceleration phase. The part where prices moved so quickly that anyone waiting for confirmation was left behind. Now look at the recent timeline. Acceleration began late in 2025. Momentum built rapidly. Silver surged toward new highs. Then suddenly came a sharp crash that shocked the entire market. Fear exploded. Confidence collapsed. But if you overlay this structure with the past explosive cycles, the current moment aligns almost perfectly with the historical shakeout phase. And if the pattern holds, and historically it has been remarkably consistent, the explosive phase may not even have started yet. But this time, there is an additional factor that makes the setup even more extreme. Previous rallies were trapped inside the old $50 ceiling. This rally already broke that ceiling. Even after a violent correction, silver is still holding above levels that once acted as an unbreakable barrier. The ceiling of the old world has become the floor of the new one. That changes everything because markets behave very differently after long-term structural breakouts. They do not simply return to old ranges. They build entirely new valuation frameworks. Imagine decades of pressure building behind a massive wall. Every year the pressure increases, but the wall holds. Investors grow comfortable believing it will never break. Then one day, a crack forms. At first, the water leaks slowly. People debate whether the wall is truly broken. But once structural damage occurs, the force behind it cannot simply disappear. The flow accelerates. That is what long-term commodity breakouts look like. And while most analysts are focused on traditional technical indicators, something deeper is happening underneath the charts. Many traders used old momentum tools to call silver overbought, and technically they were correct in the short term. A correction did occur. But those tools were built for the old trading range. Using them in a structural breakout is like measuring an ocean storm with a swimming pool ruler. The scale has changed. Monthly momentum readings have already exceeded levels that marked previous cycle peaks. The energy behind this move is historically abnormal, and when markets enter abnormal momentum regimes, old definitions of overbought become meaningless. The biggest risk becomes exiting too early and never getting back in. Now, consider what is happening in the physical silver market. The divergence between paper prices and real-world demand has widened dramatically. Reports from major trading hubs show strong premiums developing. That means the price you see on your screen is not necessarily the price required to obtain physical metal in high-demand regions. And historically, whenever physical markets disconnect from paper markets, the adjustment eventually happens upward. Add to this a persistent global supply deficit. Industrial demand for silver has exceeded supply for several consecutive years. Silver is embedded in solar panels, electronics, advanced computing systems, and medical technology. And unlike gold, most industrial silver is not recycled efficiently. Once it enters complex devices, it is effectively removed from circulation. At the same time, silver is not just an industrial material. It has a 3,000-year history as money, and shifts in monetary perception can change demand dynamics overnight. When investors begin viewing silver as a financial asset rather than only an industrial commodity, price elasticity increases dramatically. Now, zoom out to the broader macro landscape. Currency purchasing power continues to erode over long cycles. Commodity markets are beginning to show signs of renewed strength. Inflation expectations fluctuate but remain structurally elevated compared to previous decades. Government debt levels are historically high. Bond markets face increasing volatility. And whenever confidence in traditional financial instruments weakens, capital historically rotates toward tangible assets. Meanwhile, asset rotation has quietly begun. Equities have shown periods of stagnation, while commodities and precious metals have displayed relative strength. These shifts rarely happen loudly at first. They begin slowly, almost invisibly. Then suddenly the narrative flips and everyone tries to enter the same trade at once. And here is where the mathematics becomes interesting. Historically, when gold completes major bull cycles, silver tends to outperform dramatically during the final phase. The gold-to-silver ratio has repeatedly compressed during explosive moves, forcing silver to catch up quickly. If gold continues its long-term upward trajectory and the ratio moves toward historical norms, silver valuations expand rapidly. But none of this eliminates risk. Silver is volatile. Corrections can be violent and emotionally draining. Timing entries and exits is extremely difficult. Macro conditions can change unexpectedly. Policy shifts, interest rate surprises, or economic shocks can alter momentum temporarily. Anyone entering this market must understand the psychological pressure involved. Yet, despite the risks, the convergence of long-term breakout structure, persistent supply deficits, increasing industrial demand, evolving monetary perception, and broader macro instability creates a setup that is historically rare. It is not one bullish factor. It is multiple independent forces aligning simultaneously. And here is the part most investors struggle with. Explosive moves rarely feel comfortable while they are forming. They feel uncertain, confusing, frustrating. The market moves sideways longer than expected. Corrections feel deeper than expected. Confidence disappears right before acceleration begins. If historical structures repeat, the coming months could represent the transition phase between consolidation and expansion, the period where volatility increases, narratives clash, and positioning becomes polarized. Some investors will exit out of exhaustion. Others will hesitate waiting for clarity. But when momentum returns decisively, prices can move faster than emotional decision-making allows. Years from now, investors may look back at this moment as either the point of maximum doubt or the beginning of a historic repricing cycle. The crash from $90 will be remembered not only for its fear, but for what happened afterward. Whether it marked the end of a rally or the midpoint before an explosive phase is the question the market is currently answering in real time. Silver spent half a century confined within a narrow psychological framework. That framework has already begun to break. Structural breakouts change investor expectations permanently. They redefine valuation anchors. They force analysts to abandon outdated models and develop new ones based on expanding realities. And when markets undergo paradigm shifts, the biggest moves occur when the majority still believes nothing has changed, when doubt is highest, when confidence is lowest, when investors hesitate because recent pain is still fresh. The data does not guarantee a specific price target. Markets never offer certainty, but patterns reveal probabilities. And right now, the probability structure resembles the early phases of past explosive cycles more than it resembles the end of a rally. Whether silver ultimately reaches $300 by summer 2026 depends on multiple variables aligning: macro conditions, investor psychology, industrial demand growth, monetary shifts, and continued structural strength. But what is undeniable is that the setup forming today is unlike anything seen in decades. Long-term compression has already broken. Momentum structures resemble previous acceleration phases. And the combination of industrial necessity and monetary reawakening creates a unique dual demand engine. The next chapter will be written not by headlines or social media sentiment, but by supply, demand, capital flows, and human psychology under pressure. And the investors who understand how these forces converge, who recognize that massive moves rarely look obvious while they are forming, will be the ones best positioned to navigate whatever comes next. Because the real story is not just about a number like $300. The real story is about a market that may be undergoing one of the most significant structural transformations in modern commodity history. And once a transformation like that begins, it rarely stops halfway.